the way I have structured my presentation, if you may call it that, or it would be more of a session, is I would want to reintroduce UTI in two critical aspects to each one of you. All of you know UTI is the oldest fund house in the country. We started the mutual fund industry, but I'm 100% sure there will be a substantial number of people here who would not know 100% of what UTI currently stands for. So I'll take the first 5 minutes to reintroduce UTI, and post which I will take you through a journey of wealth creation, which I'm sure all of you are doing, but maybe some nuances I can value add. So currently UTI Asset Management Company has about 195 branches across the country. We have about 1,500 employees, out of which about 750 are purely core sales team members. We have over 63,000 MFDs who are empaneled with UTI, and we have another 188 district associates to increase our reach across the country where we are not present physically. So this is the sheer size, scale and volume in which UTI operates across the country. It's an AMC which has a true pan-India presence. Across Tier 1, Tier 2, Tier 3 cities, we are present wherever you want us to be present. And we have services extended across the country with a dedicated sales staff. The second, before I come to the second slide, I would just want a quick poll from the audience as to what do you think is the current AUM that UTI manages, the assets under management of UTI? Anybody? Quick call. Quick call. It's eating into my time, so quick call. What is the current AUM that assets under management that UTI manages? 2 lakh, 2 lakh 50, 290, any other call? 5 lakhs, 4 lakhs? Okay. So, as of June 2023, UTI as a group manages 16.13 lakh crores of assets under management. It is the second largest pure play asset management company in the country after SBI. We have, when UTI got listed, this is the group that got listed. This is the group which manages 16.13 lakh crores of assets which got listed in 2020. Okay? It is broken down into various businesses. The AMC business as of now manages about 2.5 lakh crores. The retirement business, which is the NPS, manages about another 2.5 lakh crores and growing rapidly. We know in the developed market, 65 to 70% of retiral corpus is in the capital markets, right? I mean, the capital market, 60-65% of the capital markets is retiral corpus. That is just about starting in the country. We have an international business which is about 20,000 odd crores, and there is a huge mandate that we get from the government, from CMPFO, whether it is a PPF or the EPFO, which is another about 10.5 lakh crores. In whole, the listed company of UTI manages 16.13 lakh crores as of June 23. So that is the size, scale of this organization that is there to serve you, our MFD colleagues in the country. So just to give you a brief, we have UTI International, we have Venture Fund Management International. We are waiting license to start operating in the United States. We are already operating in Singapore, England, BVI. We have the alternatives division, which manages private equity and debt funds. So there are a host of subsidiaries. This is the group that is there at your service. Just to give a link, just to give you an idea about the current avatar of UTI, which is the third avatar of UTI. It was started in 1963 by an act of parliament, after which in 2002 it got sort of by a repeal act of the parliament. We had 4 sponsors, which is SBI, PNB, BOB and LIC. After 1st of February 2003, all the NAV linked schemes came into UTI AMC, whereas specified undertaking of UTI took care of the non-NAV linked schemes. Currently, we have, after listing, we are a healthy mix of shareholders. About 45% is managed, is taken care of our 5 principal sponsors, out of which our single largest sponsor is an American asset management company by the name of T. Rowe Price. We have PNB, LIC, BOB and SBI as our other major shareholders, but they do not have a board mandated seat. It's an independent board which currently manages UTI. It's a board driven, professionally managed organization, contrary to the popular perception that UTI is the old PSU kind of a structure that operates currently. So that's a brief about UTI. We launched currently 2 NFOs in the market. In the month of July, August, we launched the UTI Balanced Advantage Fund. A lot of feedback from the market came in that you have come so late. UTI is the latest arrival in the Balanced Advantage category. Let me reiterate. We had a product called the UTI CCP, which I think all of you MFD friends would have sold because it's a truly nice investment product, UTI ULIP, and that product was categorized under the balanced category by SEBI. We had to shelf that product. We tried to retain the product, but SEBI did not agree. We had to shelf the product before we could launch the Balanced Advantage. Balanced Advantage is a product which is based on 4-factor model, which is running in the current multi-asset fund, which is a top quartile decile performer. We also launched the UTI Innovation Fund last month. And this is a fund which aims to take advantage of the growth in the economy, Indian economy, which is going to be driven predominantly by innovation, predominantly driven by technology, predominantly driven by AI. So this is a fund that we have just launched, and we feel that this is a fund that is for the new age customer to take advantage of the huge growth that this economy is expected to have using innovation as a platform. The core, funds that we have, of course, all of you know, we have the core equity fund, which is a value fund. It is now renamed as the large and mid cap fund, the focused equity fund, sectoral funds, hybrid funds, fixed income. We have funds across the product spectrum. I'm sure all of you are aware of the funds, and I'm sure my team here has made you aware of all of them. We launched 29 new financial centers in one day. On 29th of September, we launched 29 new branches across the country, 10 of which are in South. We have a coverage of 50 branches in South of the country. I'll skip some slides in the interest of time and come to the wealth creation journey, which I'm sure all of us are working hard towards, but I hope I'll be able to do some bit of value add and add some nuance to the wealth creation journey for each one of us. And it is also with respect to the perspective of the MFD fraternity. Apart from the customers, yes, all of you in terms of the MFD fraternity, in terms of growing your business, I think there are some nuances that can be taken forward from here. We all know the regular calculations. 15,000 per month for 15 years, 12% per annum leads to about 71 lakhs of corpus. And, however, what is important to note here is that how many in the industry have actually managed this over a period of 15 years. How many customers in this industry have actually managed this over a period of 15 years. Now, why is that anomaly come? Anomaly comes because we lack the discipline. If you look at an investment of 10,000 rupees per month when somebody was just born, and you look at the investment journey over a period of 60 years, with a return roughly of about 8%, coming up to 17 crores, just by increasing the returns possibility by about 12%, the overall corpus generated is 130 crores. So if any one of us here who is above 60 and feels that, I don't have this kind of corpus with me, I think there is something that we need to do to correct it for our next generation. I think it's very important to get into the habit of investing the moment somebody is born, starts working, because this is actually going to create the wealth over a long period of time. And if you feel that about 25% or 12% is a myth, the markets over the last 43 years have given a CAGR of 15.36%. Okay? The markets have given a CAGR of 15.36%. So it's not a myth. A 12% return over a long duration is not a myth. The other important highlight that comes to my mind when we talk about investor behavior is how against the market the investors' behavior is, and this is where we all as a community have a responsibility to educate our customers that they should not go contrary to what they should be doing in terms of investments. Just to give you an example, and this was a data point that we picked up during our BAF NFO. Whenever the markets have been less than 20 over the last 15 years, whenever the markets have been less than 20, what is the cumulative monthly equity inflows, mutual fund net inflows into equities, and when the markets have been more than 20? So the P is not a very, I mean, we all know it has evolved, a lot of parameters are there to manage, to get market information, but P broadly, if you look at it as an indicator of the market, of the price of the market, when the P was less than 20, we would all expect as a rational investor behavior to increase our investments into equities, right? However, the net equity inflows have been about 16,000 crores. Look at it when the P was more than 20. When the P was more than 20, the net equity inflows have been about 10.7 lakh crores into mutual funds. This is just highlighting the fact that investor behavior is contrary to what he or she should be doing with respect to being absolutely unbiased about investments. Okay, this is a proof of the fact. And of course, if you look at the 1 year CAGR, 2 year CAGR, and 3 year CAGR, obviously when the P's are high, there will be a big difference in the CAGR over the next 2-3 years, right? So the investor loses out. This is something that as a community, as a group, we need to keep on educating the investors, and I think we are doing a good job about it. And if you take the figures for the last 5 years, it could be a little different. It will not be, the gap will not be as wide as what it shows here. The business of SIP, I think everybody does the business of SIP. I think that's the most fundamental business that we need to do, because that is the long-term method of wealth creation to become a Chota Bheem. And I will just give you the magic of 2, and this is from the MFD perspective. I am talking purely from the MFD perspective as of now. The magic of 2%. What is the magic of 2%? If you are able to have a throughput of 2% of your AUM through SIP, you make your business foolproof, market proof. What I mean to say, any MFD friend who, let's say, has an AUM of 50 crores is able to generate an SIP book of 1 crore per month, then we are at about 2% of the AUM through SIP throughput. Using that, you make your business market proof, volatility proof. Your AUM is on a self-sustaining drive. You are increasing your AUM by 24% per annum just by SIP throughput. We have a fantastic example within the industry where and we have a lot of respect for the AMC. They have about 2,500 crores of monthly throughput, which clearly reflects the strength of the business that they have done, right? So this is very important from the MFD, from the distribution fraternity. We feel that anybody who can target 2% of their total AUM as a monthly throughput into SIP business, their business becomes absolutely market proof. Only 2 times in the last 25 years, there will be a negative growth in your AUM. Otherwise, in all the years, there will be a positive growth in your AUM. Cost of delay, I think this has been discussed quite a bit. I think every 5 years, if you have a delay, this is again from a customer perspective, every 5 years delay doubles the SIP amount that you require to get to a particular goal. Supposing you want a retirement corpus of 1.5 crores at the age of 60 years, at 12% per annum, you lose every 5 years, your SIP amount keeps on doubling. So delay of every 5 years roughly gives an amount, doubles the amount, SIP amount that you require for, reaching the same goal. So again, the other example about cost return, delay of investment, somebody starts at the age of 25, somebody at the age of 45 and 45, and even if you look at increasing the SIP amount from 15 to 35,000, keeping the rest same, 12%, roughly 60 months, total of about 15 years, you know, the net that you get is much lesser than what you would have got had you started earlier. So that's a simple calculation. I think all of us are following it. SIP, the cost of delay is very, very, very severe. Therefore, one needs to understand, to create wealth to your customers, to yourself, please start as early as possible. The second thing, you know, which is very critical here is the stepping up. And I'll just give you an example of how, you know, increase of a fixed amount at predefined intervals increases the wealth creation, hastens the wealth creation journey extremely fast. You look at a regular SIP of 25,000 with a step up, and the same with a step up of 5,000 rupees over a period of 15 years, the difference with the same rate of return, expected rate of return, the difference is almost about 1 crore and 20 lakhs, which probably in a city like Bombay, you know, gets you an extra bedroom, or in most other cities can get you an extra flat. So depending on the place that you stay, I think the difference just by a step up of 5,000 rupees over a 25,000 rupees SIP gives you that additional amount, that additional corpus that can give you a significant wealth creation. Okay, now just to highlight this, now you have a customer who's not in a position to give you an SIP of 10,000 rupees, but he or she has a target of creating a corpus of 50 lakhs for maybe education for their children. And you have, so the first option is obviously if you do 5,000 rupees let's say for 15 years, you end up at a corpus of 25 lakhs. But if you look at the third option, which is the same customer with 5,000 rupees, but a step up amount of only 1,000 rupees per year, only 1,000 rupees per year, over the next 15 years, gets to the goal of 51 lakhs. That's the power of step up. And let me flip it around. This is the AUM that gets generated in your ARNs. It is wealth created for the customer. It is AUM generated for your ARN, right? So a simple step up, if you can ensure that 60, 70, 80% of your SIPs are through step ups, your wealth creation journey for your clients and therefore for yourself becomes much, much more easier. SIP stoppages, you know, that's a bane in the industry. I think it's very important to ensure that we keep a track of the stoppages of SIP, because that is a wealth eroder. Just like SIPs are wealth creators, SIP stoppages are wealth eroders. And I'll give you an example. So if you take an example of our UTI Flexi Cap fund, and April 2020, when it was at the bottom, when it was giving minus 9.22% returns, you know, the chances of SIPs being redeemed or stopped were extremely, extremely high. However, if you come to today, which is October 23, you look at the reward for patience. The returns would have been about 13.11%. So time in the market is much, much, much more important than timing the market. You have to be in the market rather than try to time the market. So that's very important. SIP stoppages is something that you need to ensure that you educate your customers that they desist from, because that's a wealth eroder. It's not a wealth creator. This is another example which is there. I mean, if you look at again Flexi Cap Advantage, Flexi Cap fund from November 2005, 2008, when the market bottomed out, the CAGR was minus 14.27, a high chance of redemption. Somebody waited for the next 2 years, they got 21%, 20.5%. That's the reward. They went for another 10 years where it was 9.49. They got frustrated, might want to get redeemed. They waited for another just about 2.5 years, 3.5 years. They got 13.64. So that's the reward for patience. So that's, and this is from 2005. This is CAGR from 2005 November. So time in the market, as I said, is very important rather than timing the market. That's third. The another concept is the margin of safety, which, you know, SIP sort of enables you to have. Warren Buffett said the three most important words in investing: what is your margin of safety? The more the time you spend in the market increases your margin of safety. If you look at, again, giving an example of the Flexi Cap Fund from 2005, in August 2006, the average cost of purchase of Flexi Cap Fund versus the NAV movement, versus the market movement, the difference was about 1% margin of safety. Come to November 2009, it's about 25% is the margin of safety, and in November 22, somebody stayed invested, the margin of safety goes up by 70%. That means today the market has to tank by 70% for that particular investor to get negative returns, to get zero returns. So, you know, you are increasing your margin of safety with time. So please ensure, be in the market for the long term, because that reduces your average cost of purchase, thereby increasing your margin of safety and thereby giving you much more leeway in terms of your investments. So number of years goes up, average cost per unit comes down, margin of safety goes up. So we offer the same features that most AMCs have, so I'll not repeat that. So business of SIP, as I said, 2% to become market proof in your business. Be smart with a step up SIP that increases your returns for your clients as well as your AUMs much faster. Delay, of course, everybody knows, delay every 5 years doubles the SIP amount to reach a particular goal. Time in the market is more important than timing the market. Margin of safety increases with time, the longer that you stay invested. Investor behavior is something that we need to keep track of. They will generally pull out when the markets are high, or you know, bottomed out. They will generally pull in when the markets are high. That's contrary to logical investment theory. One has to be in the market consistently, curtail SIP stoppages. So that's from my side. Thank you for being a patient audience and wish you all the very best for the next 2 days. Thank you very much.